Today's topic, equity markets and the DoubleLine equity offerings. So first, on the left-hand side, we have the DoubleLine Shiller Enhanced CAPE Mutual Fund, and it's just various share classes, minimums, and expense ratios. And then on the right-hand side is the DoubleLine Shiller CAPE US Equities ETF, and of course, the DoubleLine Fortune 500 Equal Weight ETF. Now we just have some notes from our friends in compliance, and then just some brief performance snapshots before I turn it over to Jeff here. So CAPE, so starting with the ETF, so that's CAPE. Looking at performance, you'll see that the fund, this is as of April 30th, is outperforming the S&P 500 year to date by 556 basis points, and about 317 basis points over the 1 year. And that's, of course, net of fees, again, as of April 30th. Next up is the mutual fund. So this, of course, has the fixed income component, but similar story. You'll see it is outperforming year to date by 571 basis points, and then over the 1 year by 273 basis points, again, net of fees. But Jeff will get more into more detail on all of this. And then lastly, the most recently launched, at least equity ETF here at DoubleLine, DFVE, or how we refer to it internally as D5. This was launched in January of last year. As of this print, again, April 30th, it was down 4% year to date. It's actually positive now on the year as the markets continue to change quickly. But with that, I will turn it over to Mr. Jeff Mayberry.
All right, thank you, Chris. And as you said, the markets are changing very quickly here. And we did title this "Equity Investing in an Uncertain World." And as those of you that watched the top of the hour, you noticed that Mr. Gunlock said that was the word of the day here less than a week ago after the Fed meeting. But things seem to have calmed down a lot since then. If we do look at the Bloomberg Economics has a global trade policy uncertainty index. I'm not really sure exactly how it's calculated, but you can see, very recently it was at a post-financial crisis high, very high there. And here we are today, back down kind of 9, we'll call 9 or so, as things have calmed down a lot. So where are we today? What are we seeing in terms of the overall, economy, kind of how do we think about investing in, even though I would say uncertainties come down a lot, there is still a lot of uncertainty out there, even though the trade deals are, there's some sort of framework to some trade deals, but really we're in some 90-day pauses here, and we'll have to see how things shake out here between now and July for pretty much everybody else except for China, and we have until the early August for China. So we'll kind of take a look at the economy here. Those of you that know, the real GDP for the first quarter came in at negative 0.3, so a negative GDP for the quarter. But really, you look at it, the uncertainty around the tariffs, the uncertainty around exports, that big negative blue bar there is net exports of goods and services, a negative contributor of negative 4.8%. So if you take that out, kind of want to take out inventories, still positive on the quarter for GDP. So that kind of uncertainty has really been driving that GDP number. We expect a pretty big rebound here on the second quarter when we get that number, but we'll get an update on the first quarter here later in this month. And you can kind of see how big that negative exports minus imports was by this chart. This just takes that in that section and puts it into a line chart. And you can see this is the largest ever since kind of post-World War II. At that negative, 4.8%, and it does tend to be pretty volatile. So we do think that uncertainty around this should dissipate over the next quarter, and kind of see how this kind of will go forward in terms of the overall economy. And one way to measure kind of uncertainty, other than the kind of economic uncertainty, is uncertainty in the markets, and we like to look at the kind of cross-asset volatility for that. And we have 3 different measures of volatility. The bottom one is the currency vol or FX vol, pretty low. Got a little bit of movement here off of the Liberation Day. But overall, nothing too outstanding there from an FX vol perspective. The one right above it is the kind of beigeish line, dark gray line, is the VIX. That's the S&P. That's the equity vol. It was higher earlier this month, back down to an 18 level. So that's pretty much a normal level. And then the top line is the MOVE index, which is the fixed income or the bond market vol. And again, it's down also, but you can kind of see post, and in this elevated inflation world that we've been in kind of post 2021 or post COVID crisis, we're still at a much elevated level as the baseline than we were kind of post financial crisis before COVID. And so, things are pretty normal there, but still some kind of more uncertainty in terms of the volatility side of things. And we kind of focus more on the fixed or on the equity market. Sorry, there's kind of two measures here. We have the dark blue line is the forward PE ratio for the S&P 500. That's the market cap weighted S&P 500, and then the equal weighted forward PE ratio. And we did bounce back a lot, and obviously the E hasn't changed too much over the past week, even though earnings are coming in relatively strong there. But really more PE driven or price driven, bringing that back up. But you're looking at levels where, from a market cap weighted PE ratio, you're still at pretty elevated levels. Nothing that's at a kind of unsustainable level in terms of PE, but certainly at levels where you look at it and you say, okay, over the long term, maybe this is a little more elevated level than we have been over the past 40 years or so. From the equal weight side of things, it's a little bit more normal, even though it is higher than kind of the previous peaks prior to the financial crisis, but still cheaper than the market cap weighted PE ratio. So you kind of look at that just from a pure valuation perspective. You would say, okay, maybe I want to invest in the equal weight S&P versus the market cap weighted S&P. Now, another way to look at that is the cyclically adjusted price to earnings ratio. This will come back more in when I talk about our CAPE ETF, that's CAPE, and our DSEEX mutual fund, which uses a variation of this ratio here. But when we look at the price to earnings ratio for CAPE, you look at it, it's a 34. We'll call it 34 as of the end of April. And, it's still at a pretty elevated level. So it's not as high as we were in the tech boom of 2000, not as high as we were kind of in when the momentum trades were really going off in 2022 and 2024, but still at elevated levels kind of to its long-term average. So, what does this really mean when we do look at the CAPE ratio? People like to look at it and say, okay, well, if it's elevated or above average, then maybe I shouldn't be in the stock market. When it's below average, I should be buying. But what this really is trying to tell you is that when, and it seems pretty intuitive now, but 40 years ago or so, it was pretty groundbreaking, where you look at the CAPE ratio and you say a higher CAPE ratio means lower future expected returns, and a lower CAPE ratio means higher future expected returns. And this is a good chart that we look at where you have the S&P 500 10-year forward returns, which is the blue diamonds there, versus their CAPE ratio. So we do this every month and have the 10-year forward CAPE ratios and really say, okay, well, what is that return? And you kind of break it into quartiles. And, in top four quartiles, the highest the CAPE ratio has ever been is 44.2, and lowest is 13.3. And when you look at, we have it in that table there, the current CAPE ratio is 34.8. So we're in that fourth quartile. If you want to kind of draw a line there from, we'll call it 35 or so, up to that black line, you can say that over the next 10 years, you would expect a annualized return, real return, so above inflation, of 2%. Based on the CAPE ratio. Now, there's some, it's not obviously a perfect fit there. You can get up to 6%. You can get down to a negative 2% real, but in that range. So, that black line is a pretty good indication of where future expected returns should be over the next 10 years. So, really, when you're looking at it from that investing in the S&P 500, you would expect lower future returns. And a lot of that is just because of the larger, we'll call it the Mag 7 stocks or the large market cap stocks, or have very high valuations. And if we look at the way that these have, everyone, it's there's been driven a lot of the stock market back in 2024, 2023, but it's kind of reversed a little bit this year as the market has come off of its previous high or its all-time high there on February 19th, and given a lot back there. You can see that in the red this is the change in market cap, so it's pretty close to the contribution to return. The red is the contribution from the Magnificent Seven stocks, and you can see that this is as of May 7th. So it's a little bit dated, and it's come back a little bit. The Magnificent Seven stocks have, but as of that date, you can look and see that the Magnificent Seven stocks were really most of the negative return. The other 493 stocks there in that grayish blue color were flat on the year-to-date basis. They're up positive now, and the Magnificent Seven stocks will be a little bit more positive. Also, I think the S&P before I came downstairs was almost flat on a year-to-date basis. So that kind of divergence has shrunk, but really you're looking at that market cap, larger market cap stocks had the potential for a pretty large detraction from returns. And so given that the S&P 500 is pretty heavy in terms of tech, in terms of their higher market cap weighted sectors or market cap weighted names, it is a place where you can look at it and say, okay, well, how do I want to diversify away from those large 7 names or 10 names or however you want to break it down? And one way to do that is through equal weight. So it's interesting to look at the sector weights between equal weight and market cap weight. There's very large overweights in tech. You can see that 30% of the S&P 500 as of April 30th is in tech, and pretty large overweight there in communication services on the far left, a 5% overweight. Where does the equal weight make it up? That makes it up in more of your, more industrial names. Certainly, industrials at 16% versus 9%. They're kind of in the middle, and then materials, real estate, and utilities, all three on the right, have a much larger weight in in equal weight versus market cap. So really, when we look at it, it's a way to kind of diversify away from those names. And now, those of you that bought the dip and held on and are back positive on a year-to-date basis, congratulations. I think that, that's something that we were discussing internally here. But really, when you're looking at it, we think this is probably a good opportunity to get some more diversification and maybe not be so large into tech. Or if you want to be in tech, we'll talk about different ways to kind of to play that a little bit later here. But you can see this is as of last night, with industrials the best performer on a year-to-date basis in yellow, and consumer discretionary the worst performer at the very bottom there, minus 5%. But consumer discretionary and tech, those large pieces, the two of the 3 largest pieces there in the S&P 500 on the pie chart on the right, were definitely your worst performers, and a way to really think about how to move away from that large overweight in tech, or kind of a way to kind of play that. And one way to do that is through a sector rotation strategy. One of the things we do here is we have a CAPE ETF, which I'll talk about here very shortly. It is called the DoubleLine Shiller CAPE US Equities ETF. And it was launched there at the end of March in 2022. And you can see that throughout 2022, 2023, really while the markets were kind of just bouncing along there, the CAPE ETF kind of kept pace with the S&P 500. When let's call it the AI mania, the Mag 7 really took off, the CAPE ETF underperformed a lot in 2024, and then has regained some of that, still underperforming, but in 2025 thus far has outperformed that S&P 500. And you can see over this time period, very similar volatility, a little bit lower Sharpe ratio, and very similar maximum drawdown. But if we look at, let's kind of focus in on what's happened so far in 2025. I didn't want to just do it right from Feb 19th of this year, being a little bit disingenuous there. Let's look at the whole year to date and give us a little bit more of a time frame here. You can see, as Chris mentioned, outperformance a lot through the end of April, but here through last night, outperformance of 350 basis points or so to the S&P 500. Similar volatility, or lower volatility, given that drawdown that we did have in the S&P 500. That makes sense there. So it's a way to kind of play the large cap market in the ETF space here. If we kind of let's back up. So one of the ways we do this CAPE ETF is through, as I mentioned, through a sector rotation strategy. As I mentioned earlier, also we use the CAPE ratio. So if you look on the lower left-hand side of the screen, you can see the CAPE ratio for two different sectors. You have technology in the dark blue and utilities in the light blue. And if you just invested solely on the CAPE ratio, saying, okay, I want to buy the sector with the lowest CAPE ratio because that is, quote unquote, cheaper according to that metric, you would always buy utilities and never buy technology. And for a sector rotation strategy, that doesn't really make sense. To always exclude utilities and always be buying, or always excluding tech and always buying utilities. So what Barclays did is, and they were the ones that kind of worked on this with Professor Shiller, is they came up with the relative CAPE ratio. And so the relative CAPE ratio takes the CAPE ratio, divides it by a 20-year history, and you can kind of see whether the sector is cheap relative to its long-term history. And so that's the relative CAPE ratio on the right-hand side for this cherry-picked two sector universe. And you can see using that metric, there would be times when you wanted to be in tech because it's cheaper to itself. And there are times when you would be in utilities because it's cheaper to itself than tech is. And so that makes much more sense to us from a sector rotation strategy, something that you look at tech and say, okay, is tech cheap to itself, or is it or utilities cheap to itself? And so from the CAPE index, you do have the rules on how the CAPE index is put together. So take the 11 sectors of the S&P 500 on the right, take the 5 cheapest sectors there. So it used to be half of the sectors when there were 10, now there's 11. You're still taking the 5 cheapest based on that relative CAPE ratio. So times when technology is the cheapest to itself, it would be included in there. Times when utilities is not cheap to itself, it would not be included in there. Take those 5 sectors, look at the 12-month total return for each of the sectors, and then the sector that has the lowest 12-month total return, so least positive or most negative, remove that sector. So that's the kind of the value trap filter, the trying to catch a falling knife filter, the ones that are sector is cheap for a reason, and you want to exclude that sector. So then you're left with 4 different sectors. And one of the things we like about this product is you just say, okay, you have 4 sectors. What does an academic usually do when you have 4 sectors? Just equally weight those 4 sectors. They do this every month. And so you have 4 undervalued sectors with a positive momentum. And then you kind of invest that through the month and then rerun the process every single month after that. So how does this look as of, as of April of this year? You can kind of see energy, the most expensive sector, then followed by industrials and technology. So those are your kind of 3 richest sectors. Energy, was off the charts rich according to the relative CAPE ratio. Come in a lot, and still, surprising given the fact that oil is down. It's in kind of mid 60s today, but even when it was in the high 50s there, energy still on the richer side of things according to the relative CAPE ratio. But we do have the 5 sectors that are the cheapest there: real estate, communication services, materials, discretionary, and consumer staples are the 5 cheapest sectors, according to the legend on the right there. And so we would run the 12-month total return on each of those 5 sectors. The one with the worst 12-month return, we kick that one out and reinvest the other 4 sectors. So it does tend to vary a lot. There's movements here. You can see sometimes tech is cheapest. Looking at kind of 2016, 2017, tech was the cheapest sector. You can see communication services when that kind of popped into the mix there. It's been cheapest for a long time there. That now until real estate kind of took that over the past few months. But those types of movements are really what we're trying to capture in this sector rotation strategy. And over time, you can see here's all the 11 sectors of the market. You can see communication services when it first became the 11th sector really of S&P 500. Was in pretty consistently until 2021, was out for a pretty consistent basis and has been in ever since. But it's pretty good rotation. So, tech still on the more rich side. Haven't been in tech since 2022. Certainly that led to a lot of the underperformance in 2024, not being in tech and being that largest portion of the market, and a very good performer has hurt. An interesting look at industrials. We were in industrials pretty consistently up until like 2019. and then haven't been in since. And so, this type of regime shifting, these regime changes, whether growth or value becomes in vogue and kind of on the cheaper side of things, is really what we're trying to capture here in terms of this CAPE index. In energy, haven't been in, kind of in for like a few months there in 2018, but haven't been in since. So really something where we look at it and say, okay, we've been in every sector. We went live with our this index went live in 2012, so it's been in every single sector except for utilities. And utilities came in pretty close there in 2024, but the bad momentum kept it out, even though it became one of the 5 cheapest sectors of the market. So how does the CAPE index look today? Or CAPE ETF look today? So that was the index. The ETF invests in the actual stocks. So if you're buying one of the sectors, that sector is market cap weighted. So we're going actually buying the stocks in the CAPE ETF that are in the sector. So we're 25, because we're equally weighting 4 different sectors. We're up 25% in consumer discretionary, communication services, consumer staples, and real estate. And you can kind of see those weights there. A little bit off of 25% due to the market movement throughout the month. But really where we are is equally weight those kind of 4 sectors. And, unsurprisingly, you kind of look on the left there, lower medium market cap as you're avoiding those big 7 names, those large market cap names. You have an average or a median market cap that's lower. You have an average market cap that's just slightly lower there, lower price to earnings and lower price to book. So from a sector rotation strategy, I would say you kind of look at it right now and it's much more of like a value tilt, even though you're in over time with that real estate and consumer staples weighting, but we're kind of overweight for those. But you are also in consumer discretionary and communication services. So you're not only in value, you're not only in growth. It really depends on which of the sectors are the cheapest and which of the sectors become rich, and then we're trying to get out of. And so I think that this is one way to kind of play the S&P 500 is what we like to look at is maybe you want to buy tech solely. If you want to have that tech allocation, buy tech and supplement it with CAPE and as a sector rotation strategy. You're trying to choose the kind of non-tech sectors that you want to be invested in. And that's one way to kind of put together a portfolio as a kind of a core, I don't want to say core tech, but, with 30% of the market in tech, kind of a core tech allocation and then CAPE around it. And let's go back to performance again. So this is the since inception performance for the CAPE ETF. And you can kind of see underperformance there a lot in 2024, as I mentioned, given a lot back. But we think that it's a very attractive point, and really that sector rotation side of things can help out a lot from an investment perspective. Now, let's talk about the mutual fund here. It's a kind of a very similar strategy. The difference is, as Chris mentioned at the beginning, is that we do have a fixed income piece underneath. So we look at the structure here. You've got the DoubleLine Shiller Enhanced CAPE Mutual Fund. It invests 100% notional swap exposure in the Shiller Barclays CAPE US Sector Index, which is the same index we use for the CAPE ETF. But we do this in swap exposure. We don't actually buy the actual equity securities. And because we don't buy the securities, we do it in swap form. That leaves us with the investment that we can invest in a actively managed fixed income portfolio. That fixed income portfolio is, trying to be additive to performance, increases your overall yield, and really when we think about it, is kind of combine those two pieces. Now, one thing we like to tell people is it's not a balanced fund. You get the equity index performance plus the fixed income. So when fixed income's up and equities are up, you're going to be up more, and vice versa there. So how is this performance done? Now, we launched this on Halloween of 2013. So much longer track record here. We have 11 plus years, of performance here for DSEEX. This is through last night, and you're under performance of the mutual fund by 33 basis points to the S&P 500. Now, of course, the S&P 500, you can, if you want to invest in it, you get 4 basis points or so. So it's not really you're underperformed by 30. And you can kind of see that blue line had a lot of outperformance. Gave some of it back in 2022 with the rise in interest rates that has the fixed income side detracted from returns. And then that 2024, when we're in tech, also detracted a lot from returns relative to the S&P 500. Kind of gained a lot back, as I mentioned, on the CAPE ratio or the CAPE ETF so far this year. The fixed income has been accretive to the portfolio. And so making a lot of that back here on a year-to-date basis, which you can kind of see on this slide. Here we are, 350 basis points over so far this year from the combined CAPE index plus the fixed income lower standard deviation. And so you can kind of see here, same idea as the CAPE index, because that CAPE index is much more volatility driven, drives much more the volatility in the mutual fund than the fixed income side. The fixed income side it just tries to be accretive to the overall portfolio. And the way we do that is through a diversified fixed income portfolio. And when we look at it, here we have on the right-hand side, the sectors of the market. And you can see that we're not trying to take a lot of risk on this side of this side of the portfolio. You can see, there's no high yield. You see high yield in the legend there. That's that color that disappears in 2015. Have no high yield since 2015. Our emerging markets is at its lowest allocation ever. It's the very top color there. Bank loans at a very small allocation, and then the ones at the bottom, they're the governments and cash are really at a much lower much higher allocation as we've kind of continue to de-risk on the fixed income side of things. But it is actively managed. And you kind of see how it's pretty, those allocations shift over time as we try to take advantage of different opportunities in the shorter duration fixed income space. And here's a pretty good snapshot of our portfolio characteristics on the fixed income side. So as I mentioned, we're not taking on a lot of risk. We have a duration of 1.6 years, so we're not taking on a lot of duration risk. You're picking up 4.9% in the yield to maturity, and it's diversified across all the different fixed income sectors. Kind of almost the contribution is almost it's very similar to the sector breakdown, which is on the right hand side there. And you can see that we're 35.5% in government-backed sectors. Really, this is kind of your flight to quality, your side of things where you're like, okay, well, if we get a recession, how do we want to have this portion of the portfolio to act? How do we want how do we want the fixed income to act there? And even in the credit side of things, even though it looks large at a 61% credit allocation, it is very much in the investment grade space. So on the bottom right, you can see that, between double Bs, single Bs, and triple Cs and below, you're about 5% of the portfolio. You have about 3% in unrated securities. That's mostly in the non-agency RMBS space. And then we have 3% cash today. So we're not trying to take on too much risk there. We're just trying to add incrementally to returns. So the idea in DSEEX is to add, call it 100 basis points over funding cost or over cash over a long term, over the entire business cycle. And if we can do that, that adds 100 basis points to the overall returns of the portfolio. And over time, we think that the CAPE ratio, the CAPE index, via the CAPE ratio, should add about 100 basis points of outperformance over the S&P 500. Put those together, and you get S&P over or 200 basis points over, or you get DSEEX at 200 basis points over S&P 500. So I'm getting a little tongue-tied there. But really, when we look at it, we're at a place where it's a pretty good value here. If the Fed starts cutting rates, your funding costs will go down. A lot of your yield to maturity should stay pretty stable there from the fixed income side. And it's a kind of a good place to be investing in both portions of the market. Let's shift focus here for a second to our other ETF, not market cap weighted, but equal weighted. And it's the DoubleLine Fortune 500 Equal Weight ETF. As Chris mentioned, we call it D5 or the ticker is DFVE. Another way to invest in the market. If you look at the, people, if you went to a bar and you tried to bet people what would be the better performer over the past 22 years, whether is it going to be the S&P 500 equal weight or the S&P 500 market cap weight, you'd probably win $1 from your friends because they would all say the market cap weighted would outperform the equal weighted. But that's actually not the case. Certainly the market cap has made up a lot of ground here over the past 17, 18 months. But over time, look in the bottom right, the equal weight has been outperformed by about 40 basis points over the market cap weighted. A little bit higher standard deviation, as you would expect, giving a little bit more of that small to mid cap bias, given the larger weightings to those smaller securities, similar Sharpe ratio, and a little bit higher maximum drawdown. And really, when you look at it, this chart isn't all that helpful, but it is kind of eye-catching when you look at the, we kind of jokingly put the equal weight line there, but really look at the top 10% weighted names there and how large those are in terms of the total market cap of the S&P 500. Even the next 25 is a pretty big weight, and then you get to the last remainder, which is 400 or 300 odd names, and they're very much below the equal weighted level. You can kind of see where the equal weight makes up its difference in terms of the in terms of its allocation. And this is a kind of, I think, this is a better way to look at it. It's not as eye-catching though, but really, you look at the top 10, unsurprisingly, in the equal weight, top 10 times 20 basis points gives you 2%, and then 25 times 2 basis points give you 5%. And so it goes from there. But really, you can say the top 10 weight is 34% in the market cap weighted S&P 500, and then 19, and then 10. And so when you look at the equal weight, you're obviously very much higher weighted to the much smaller names and underweight the much larger names, which tend to be on the tech side of things. You can see there are times when, if you look at the, probably should have flipped this because we're trying to sell the equal weight index. But when the bars are negative here, when the bars are below the axis, equal weight is outperforming. And when the bars are above the axis, that's when market cap's outperforming. And you can kind of see that red bar is so far here in 2025 through last night. And the equal weight index has been outperforming so far this year, outperforming in 2022. In times of stress, in times of 2020 or 2009, after the financial crisis, the equal weight outperformed a lot. Kind of post tech bubble, equal weight outperformed a lot. And so you can kind of see those are the types of markets when the equal weight tends to outperform, when that market cap gets a little bit top heavy, and things kind of normalize from there. And this is a good chart. I like this chart that we put together this morning, or we put it together, updated it this morning as of the end of April. And you can kind of, your eye kind of draws a line where the blue line starts to go down from its peak, and you kind of see the black bars are negative, or the black bars go down. That's when the equal weight outperforms, whether that is in 2008 or 2009, whether it is, today. This hasn't come through yet because we haven't had to have a 1-year return where the equal weight is outperforming the market cap. But you kind of see that that blue line coming down is indicative of the potential for that equal weight to outperform. Whether that continues or not, if we didn't update this as of April, if we updated it as of March, that blue line would look like it's going to continue to go down, but it did bounce a little bit there in April. But this is really interesting where you look at that kind of top heaviness of the S&P 500, the top 10 stock weight, highest since, it's just off the highest it's been since 1995, but really that it doesn't have to be, it's not really indicative of how much of a outperformance you're going to get from the equal weight side of things, but it is indicative of that relative outperformance or potential outperformance from the equal weight side of things. So this is all equal weight from the S&P 500. So same exact constituents from the S&P 500 market cap versus the S&P 500 equal weight. Now let's shift gears just slightly to the Fortune 500. And everyone's probably heard of the Fortune 500 list. There's a lot of information here on this. But really what we want to know is the Fortune 500 lists the largest 500 companies based on their total revenue for their fiscal year. It's not a committee that decides the largest market cap names or decides kind of, ad hoc on what they want to add to the index to kind of drive more interest in the index. It's a very quantitative measure where where Fortune just lists them by the top 500 in terms of revenue. Walmart is the top spot there, unsurprisingly for the 11th straight year, and that Robert Half was the smallest revenue generator, last year to make the list at $7.2 billion in revenue. Now, how do we invest in that? Doesn't mean that we're just going to invest across all 500 names there. Some of them are private names, so we obviously exclude those from our index. If you're not traded on a stock exchange, you're excluded. If you're kind of limit MLPs and things that have very low volume or very low, or haven't been listed for very long or very, very low volume, we kind of want to keep the liquidity of this index very high. So those are eliminated. And so you kind of come up with this list of 400 odd names and equally weight those from that Fortune 500 list. Now, the difference between a market cap weighted list and an equally weighted list is that in a market cap weighted list, you don't have to rebalance. You can kind of just let it go, and that's let your runners run. And that's one of the benefits from the market cap side of things. Your trading costs are relatively low. For an equally weighted index, you do need to rebalance in order to kind of maintain that equal weight, maintain those benefits from equal weight. That rebalancing, you're rebalancing to the things that have underperformed, and so on the things that have outperformed. That kind of rebalancing, as you get some reversion to the mean, should be accretive to the overall portfolio and the returns. So we do that, and we rebalance this index every quarter. As I mentioned, we get 400 odd names here. Here we are, 2024. We had 459 names. S&P 500 had 503. So I think that some of those are kind of double counted names in the S&P 500. So slightly less names in the Fortune 500 index. But the interesting part is that column on the far right, where there are 131 names that are in the Fortune 500 index, or the Barclays Fortune 500 index, not the Fortune 500 list, but the Barclays index, that are not in the S&P 500. So you can look at that and say, some of those names in the S&P 500 aren't necessarily the highest revenue generators. There are ones that are maybe a little bit more on the side of more pomp than revenue. But here we are. This list is diversified. It is diversified away from the S&P 500. And so over time, the index, we'll call it the BFEWI, which is the Barclays Fortune 500 Equal Weight Index. Went live in August of 2018, and that is the blue line on this chart here. The gray line is the S&P 500 equal weight. So over time, over the live data of the Barclays Fortune 500 Equal Weight Index, it has outperformed the S&P 500 equal weight by 140 basis points. So you take all of the benefits that we saw of the S&P 500 equal weight to the S&P 500 market weight, kind of add on some more alpha using this different list of names in the Barclays Fortune 500 Equal Weight Index, and you get some more outperformance there. Higher Sharpe ratio, very similar standard deviation, and a little bit more drawdown there happened in 2020. So we think that this is a better index, a better way to invest in an equally weighted index, and also gives you a little bit more diversification away from those S&P 500 names than you would get from the market cap side of things. And here's a huge wall of numbers. I won't go over all these, but you can see this is since inception of the Barclays Fortune 500 Equal Weight Index. Kind of a couple of things to peek on here. The correlation between the Barclays Fortune 500 Equal Weight Index and the S&P Equal Weight Index is 0.98, so very, very highly correlated. And then some of that outperformance is due to the alpha component of the Barclays Fortune 500 Index. That's the fifth from the bottom. Fifth from the bottom. You have an alpha of about 100 basis points per annum since inception. So it's not just taking on more risk. It's very highly correlated. The beta is 1.06. So really, you're just getting some more alpha. Now, when we did talk about this is kind of a messy chart here, but really you're looking at the Barclays Fortune 500 weightings. That's the blue line. Let's compare that to the dark gray line there, which is the S&P 500 equal weight. And the overweights in the Barclays Fortune 500 are very high in consumer discretionary. You have a little bit in consumer staples and a little bit in materials. Large underweight in the Barclays Fortune 500 to information technology and real estate are kind of the two big ones there. So you can kind of see that when you kind of look at it, we have the number of names at the bottom there. So we are buying the equities here. So when we're buying, when we look at the list of 457 names in the Fortune 500 Equal Weight Index, we have 457 holdings here. as you can see under the portfolio characteristics on the right-hand side. Median market cap, average market cap, and PE. Because we are equally weight, it is much lower than when we're looking at the numbers for CAPE, and really trying to add a little bit more value here. But you're not choosing just sectors; you are invested across all the sectors. Here, at least, we have it's kind of odd, but almost exactly the same, or at least to 2 decimal places, the exact same sector allocation to consumer discretionary and industrials. But you're much more diversified across the different sectors of the market, because you are equally weighted. So it's really dependent on the number of names. And how is that performed? And so this is we launched our ETF at the end of January last year. As you would expect, it's 2024, given that, as I mentioned, same with CAPE, the AI boom, the market cap weighted, larger market cap weighted names, giving a lot of outperformance. We did underperform there in 2024. And made some of that back so far in 2025. But even though it's pretty close in 2025. But overall, you look at it, you can see that on the bottom, you can see that our equally weight ETF is 12.6% return versus the S&P 500 equal weight 12.3. So picking up 35 basis points so far per annum here over the last, we've only been going at this for 12, 13 months or 13, 14 months now. And kind of let's zero in a little bit on the year-to-date numbers. As I mentioned, a little bit underperformance versus the S&P equal weight, but outperformance versus the S&P market cap. And so for us, when we look at it, we can say, okay, it's a different way to invest if you want to be a little bit safer in times of uncertainty. As we kind of bring things all back around here, I think that it makes sense to not invest only in the S&P 500. Don't overweight those large market cap names. Maybe do it. You can invest in CAPE. You can invest in that sector rotation strategy. You can be a little bit more, stay in those large cap names and really try to take advantage of the cheaper sectors of the market. If you still like tech, and a lot of people still do, and I know I personally still like tech, I think you can kind of invest in tech separately, because you're want to be kind of it's hard to be market weight in that sector in any sort of real way. So invest in that separately. And then have your sector rotation strategy. Those of you a little more conservative, a little bit more worried about how things are going to go, how things are going to go past these 90-day delays in the tariff side of things, or if you think that there's maybe a potential for more of a recession coming out here, then maybe you want to invest on the equal weight side of things and be much more diversified into your small and mid cap names, a little bit less to the large cap names. And really try to be at a place where you can, we like to say you want to have a sleep at night portfolio. You don't have to be worried about your over investment. So you could buy that equal weight side of things. And, if you still want to have that, that side of things where you want to be in tech, I would suggest a kind of a tech investment on the side there also. That's kind of our slides here. Let's look at, we do have a few questions here. One of the questions is kind of how would you allocate to a equal weight versus or have a meaningful impact on performance from an equal weight? That's a good question. It depends on how much risk you want to take, how much risk you are comfortable taking. And as with any of these types of questions, it all depends on your risk profile. But you want to have a meaningful weight. And so I think that it makes sense to have you can kind of, as I mentioned, kind of take your equal weight or sector rotation strategy, supplement that with tech, and have that be your kind of overall investment. You don't have to invest in the S&P 500. It does have its shortcomings, and really can be at a place where you where that can help from a diversification standpoint. Hasn't helped, it didn't help in 2024, but we think that that's kind of I would say that's more on the anomalous side of things, and that going forward, it could definitely be helpful, especially if you think that we're in for more of this volatility and uncertainty that we've had, at least over the past couple months. Then we have a question on what's our outlook for the fixed income portion of the Shiller Enhanced Caped Mutual Fund. And, we are yielding around 4.9 today. I think that, there are opportunities in the fixed income market, and we're really on the more conservative side of our fixed income portfolio, across the board, across all of our fixed income products, asset allocation products. And I know, we have on the screen right now the webcast replays, and I know Jeff Sherman back, way back in April 8th, a month ago, was talking about how we've been de-risking our fixed income portfolios. That includes the fixed income side of CAPE, or the Shiller enhanced CAPE. And we think that it makes sense that at this point in time to continue to do that. Your opportunity cost is pretty low, and you're not getting paid enough value to really go down and take on a lot of fixed income risk. Certainly not in a portfolio or a strategy or portfolio like DSEEX, where you have a lot of your equity risk also. There's no point in compounding on that risk in your fixed income side of things. Okay, so we have a question on, is the equal weight and or sector rotation for CAPE tactical when equity concentration is high, or more of a permanent allocation? And, I think that it makes sense to be tactical now. I would suggest that it's much more of you can make it much more of a strategic allocation. But given the large overweight, the large weighting to the kind of large cap security or stocks, the Mag 7 is a huge portion of the index. That it certainly makes sense from a tactical perspective to be overweight, equal weight and overweight, kind of the sector rotation, moving away from those names. But also, I think that from a long-term perspective, as we saw with the S&P 500 equal weight return versus the S&P 500 market cap weight, you can get some that rebalancing effect, that kind of picking up some small and mid cap exposure from that equal weight side of things can lead to more incremental returns over time. So I think it's kind of I would want to have a strategic allocation to like an equal weight, but I also think that now is a very good time from a tactical perspective to do that. And finally, we have a question that says, have we tried to apply our thinking a step further? So ranking companies instead of a sector. Yeah, I think that is something that is out there. I think the way we look at it and the kind of the problem with that, and this is kind of the same thing. We do have a international CAPE version of the mutual fund. The ticker is DSEEX. And we call it DSU, and that invests in Europe. And even then, even if you're in Europe, you don't have enough data to get your CAPE ratio and your 20 years of relative CAPE ratio. To do that on an actual individual security basis, you'd only be looking at securities that have that have been around for 30 years. You can kind of try to cut that off a little bit, but even maybe you want to be a 10-year history, but then you still have to have companies that have been around for 20 years. So it becomes a lot harder to do as you kind of go smaller and smaller in terms of your scope. It becomes much harder and harder to do because you just don't have the data for it. And one thing that Professor Shiller is very good about is having very, very long data sets. He loves those long data sets. The stock market's going back to the 1800s. He loves those data sets. And so I think that, there are ways around that problem, but for us, we really like the sector way because you can kind of backfill all this data in back through time. And there's this index went live in 2012. And so we have data from 2012 on that's live. They have a back test from 10 years before that. And it's really hard to get much longer data back further, even though you would think it'd be easier. It's pretty hard. And so there's not very many companies that have lasted that long. And when you kind of think about, you've seen that chart a lot where the longest, whatever the largest company is in the index and how that goes away, and then a new company comes in to take its place, that kind of rotation side of things becomes much more of a problem over the long term. Oh, and finally, I got another question. Okay, great. How do you see the market and U.S. economy going forward? Will we test the lows again, or has the market recovered and earnings will be okay going forward? Now, it's interesting that there's a lot of uncertainty, so I'm not going to be able to say, okay, this is exactly what is going to happen. I do think that the market, we are in a place where the tariffs are much higher than they were coming into the year. We're kind of in that the same level as we were like in the 1920s and the Smoot-Hawley era. Overall tariffs are still high, even given the deferrals that are kind of caused the market to rally a lot over the past couple of days with China and the U.S. And so I think that there's still going to be a drag on the economy overall, but also we're so much uncertainty over what's going to happen over the next 90 days, right? So the China tariffs are 30%, but that only lasts until the beginning of August. The other tariffs that the U.S. kind of dialed back to the kind of the 10% floor, that only lasts until the beginning of July. So we're going to need to see a lot of progress from the trade deals or more trade frameworks coming out, like we got with the UK, over the next 2 to 3 months for the tariff side to really not affect things. And I think you've seen a lot of the, we were looking at a chart this morning that earnings guidance or earnings EPS guidance on a forward-looking basis is only down 2% as of right now. And we were discussing it on the trading desk this morning, and we think part of that is what do the analysts do when a company says no more guidance? There's too many unknowns. They don't know how things are going to shake out, so they don't offer any forward guidance. Are the analysts just kind of leaving things unchanged? How are they adjusting that? And that's kind of the big question going forward. And that's really what no one knows. And so I think that there's going to be bounces. There's going to be a lot of volatility. There's still a lot of uncertainty going on. And so I think that I think the economy, if we kind of stay in this place, we'll kind of chug along. We'll get a pretty good GDP number in the second quarter off the back of the bad GDP number for the first quarter, and that the economy really will continue kind of at this pace. Nothing too large, nothing too small. How the stock market reacts is anyone's question. I think that you get more trade deals, more frameworks, and the stock market will go up here. And I think it's a good time to maybe get in. If you kind of pull back after Liberation Day, you can get back into the market now, kind of unchanged. Or if you pull back going into the beginning of the year, you're still unchanged here. But really, I think that you're really at a place where you can look at it and say, there are some positives going forward, that things won't be as bad as they thought. And that it does seem, despite the administration's claims at the beginning of the year, they do seem that they are still looking at the stock market. And every time the stock market goes up, they do say, okay, look at the stock market. It's a good time to buy. I think that's right. And I think that you're at a place where maybe the trade deals, the Trump administration blinks, you get better trade deals if the stock market is down. So I guess it's a long-winded answer of saying I don't really know, but I can make the case both ways. But I think that really from a market perspective, from an economic perspective, I push more towards the no recession growth side of things than kind of getting a recession before the end of the year. With that, I'd like to thank everyone for listening, and given this time of uncertainty, I'd say good luck out there.